Hashtag DeFi explained, the future of banking without banks. Hashtag Blockvault daily. Imagine walking into a bank, applying for a loan, and being rejected, not by a human, not by a committee, but by a decades-old algorithm that knows nothing about your actual financial behavior. Now imagine an alternative world where you can borrow money, earn interest, trade assets, and build wealth, all without ever asking anyone for permission. No bank manager. No credit score gatekeeping. No business hours. Just open, transparent, programmable money running 24 hours a day, 7 days a week. That world already exists. It's called decentralized finance, and it may be the single most disruptive financial technology since the invention of the internet itself. To understand why DeFi matters so deeply, we first need to understand what it's replacing. Traditional banking has existed in roughly the same form for centuries. You deposit your money into a financial institution. That institution lends it to others, collects interest, keeps a fraction for themselves, and returns a much smaller portion to you. The bank acts as the trusted middleman, the intermediary that every single financial transaction must pass through. And for most of modern history, that model worked well enough that most people never questioned it. But the 2008 financial crisis cracked the trust permanently. Banks made reckless bets with customer deposits, governments bailed them out using taxpayer money, and millions of ordinary people lost their homes, their savings, and their financial futures. Out of the ashes of that collapse, an anonymous developer named Satoshi Nakamoto published a white paper introducing Bitcoin, a digital currency that could transfer value between two people without any bank involved whatsoever. Bitcoin proved the concept. But it was Ethereum, launched in 2015 by Vitalik Buterin, that truly opened the door to what we now call DeFi. Ethereum introduced smart contracts, self-executing pieces of code that automatically enforce the terms of an agreement the moment predefined conditions are met. No lawyers. No banks. No trust required between strangers. The code itself becomes the institution. So what exactly is DeFi? At its core, decentralized finance refers to a collection of financial services and applications built on public blockchain networks, primarily Ethereum, though chains like Solana, Avalanche, and BNB Chain have also become major players. These applications replicate virtually every service a traditional bank offers: lending, borrowing, trading, savings accounts, insurance, derivatives, and more. The critical difference is that none of these services require a central authority to operate. They run on smart contracts that anyone can audit, anyone can use, and no single entity can shut down. The numbers tell a striking story. At the peak of the DeFi boom in late 2021, over $175 billion in total value was locked inside DeFi protocols, meaning that much real money was actively being used within these systems simultaneously. Even after significant market corrections, the total value locked in DeFi remained in the tens of billions of dollars throughout 2023 and into 2024. Demonstrating that this isn't a passing trend but a structural shift in how people interact with money. Let's break down the four major pillars of the DeFi ecosystem, because understanding each one reveals just how comprehensive this financial revolution truly is. The first pillar is decentralized exchanges, or DEXs. In traditional finance, if you want to trade one asset for another, you go through a brokerage or an exchange that matches buyers with sellers. In DeFi, platforms like Uniswap, Curve, and SushiSwap use a mechanism called an automated market maker, or AMM, to facilitate trades. Instead of order books, these platforms use liquidity pools, large reserves of tokens deposited by everyday users who earn trading fees in return. Uniswap alone has processed over $1 trillion in cumulative trading volume since its launch, rivaling the transaction volumes of some major centralized exchanges, all run entirely by smart contracts with no central company controlling the trades. The second pillar is decentralized lending and borrowing. Platforms like Aave and Compound allow users to deposit crypto assets as collateral and borrow other assets against them instantly, globally, and without a credit check. The interest rates are set algorithmically based on supply and demand. When a particular asset is in high demand for borrowing, rates go up. When supply is abundant, rates come down. Aave, for example, has facilitated billions of dollars in loans and introduced innovative features like flash loans, loans that are borrowed and repaid within a single blockchain transaction, enabling complex arbitrage strategies that were previously impossible. The third pillar is yield farming and liquidity mining. This is where DeFi gets truly creative. Users can move their assets between different protocols to maximize the returns they earn, a practice known as yield farming. During the peak DeFi summer of 2020, some protocols were offering annual percentage yields in the hundreds and even thousands of percent. While those extreme numbers reflected unsustainable token incentives, yield farming established a new paradigm, users being compensated not just with interest, but with governance tokens that give them actual ownership stakes in the protocols they use. The fourth pillar is stablecoins and their role in the DeFi ecosystem. Stablecoins like USDC, DAI, and USDT are pegged to the value of the US dollar and serve as the backbone of DeFi liquidity. DAI, created by the MakerDAO protocol, is particularly fascinating because it's a decentralized stablecoin. Its value is maintained not by a central company holding dollar reserves, but by smart contracts managing over-collateralized crypto positions. It represents a completely new form of monetary engineering. Now that we understand what DeFi is, let's go deeper into why it represents such a profound shift in financial power dynamics. The most compelling argument for DeFi isn't technological, it's humanitarian. Approximately 1.4 billion adults worldwide remain unbanked, according to World Bank data. These individuals lack access to basic financial services not because they don't deserve them, but because they don't live near a bank branch, they can't afford the minimum balance requirements, they lack government-issued identification, or they live under governments with unstable currencies. DeFi requires none of those things. All you need is a smartphone and an internet connection. Consider a farmer in rural Nigeria who wants to save money but has no access to a reliable bank. With a simple crypto wallet, that farmer can deposit stablecoins into a DeFi lending protocol and earn a yield that almost certainly exceeds what any local bank account would offer if local bank accounts were even available to them. This isn't a theoretical future scenario. This is happening right now, across dozens of countries where people are using DeFi to escape currency devaluation, access global financial markets, and build financial security outside of broken or corrupt banking systems. But DeFi is not without its risks, and intellectual honesty demands we address them directly. Smart contract vulnerabilities represent one of the most significant dangers in the space. Because DeFi protocols are run by code, a bug in that code can be catastrophically exploited. The history of DeFi is littered with high-profile hacks. The Ronin network bridge was exploited for over $600 million in 2022. The Wormhole bridge lost $320 million in a single attack. The Euler Finance protocol was drained of nearly $200 million before the hacker eventually returned most of the funds. These aren't edge cases, they're reminders that immutable code is only as trustworthy as it is airtight, and writing perfect code is an extraordinarily difficult challenge. Regulatory uncertainty is another major headwind. Governments around the world are actively wrestling with how to classify and regulate DeFi. The United States Securities and Exchange Commission has taken an increasingly aggressive stance toward crypto broadly, and DeFi is firmly in its crosshairs. The European Union's Markets in Crypto Assets Regulation, known as MiCA, establishes a framework that could significantly reshape how DeFi operates in European markets. How these regulatory battles resolve will have enormous implications for the trajectory of the entire ecosystem. There's also the complexity barrier. For all its potential, DeFi remains genuinely difficult to use for non-technical users. Managing private keys, understanding gas fees on Ethereum, navigating multiple protocols and interfaces, these create friction that prevents mainstream adoption.